Welcome in, folks. It's a buy one, get three free. 4 videos up for me to react to in this one. Palantir CEO went on CNBC and was speaking just a moment ago, 54 minutes ago. So looking forward to hearing what Alex Karp has to say in regards to that one. I'm sure he's going to make some pretty big statements. From there, we're going to get into this one, and it's a subject I've been talking about a little bit. There's a chance the Fed won't cut rates at all this year. I think that's an important subject to get into. I think there's probably about a 40% chance of that. I do think they're probably going to cut in July. That's when the cutting cycle probably will start. But, you know, there's odds on everything. And if I had to put odds on the Fed doesn't cut at all this year, I'd put it at about a 40% probability. So looking forward to getting that one. Then we're going to speak about AI hype. Obviously, NVIDIA, Palantir, all the stocks that have, a lot of people are excited about for AI. If the hype's overblown, so good little debate here to react to. And then last one up here, House passes a TikTok bill. So I think this should be an interesting one to get into because obviously this has ramifications for a lot of companies. It has ramifications for obviously companies like Meta and others. So I think that's a big one to get into. So appreciate y'all joining me as always. Thanks so much for being here. All I ask in return, smash a thumbs up. Make sure you're subscribed here to the channel. If you're not already, we're at a new all-time high subscribers in the history of the channel. Also, if you're looking to apply to join my private stock group, that's going to be the pinned comment down there today if you're looking to apply to join in there. Alrighty, guys, let's get into this.
Our Sarah Eisen is sitting down exclusively with Palantir's Alex Karp. Morning, Sarah.
Good morning, Carl. Yes, I am here at the Comcast Business Technology event, which is on the sidelines of the Players Championship in Florida. And joining me is Alex Karp. He is the CEO of Palantir. It is great to speak with you.
Very nice
Welcome.
to be here. Happy to be among the players.
Yeah, same here. So I want to talk about the stock for a moment. It has boomed, and you have seen a lot of growth recently driven by commercial accounts, corporate customers. What's driving that?
Well, I mean, America. America is the most meritocratic, competitive market in the world. And so that's obviously a huge advantage for us because our basic claim to fame is the software. Historically, over 20 years, the stuff you're installing isn't going to work. What we're doing will work. It's not, we built the software in a way maybe you wouldn't think it should be built, but that is the way it should be built, whether that's been on the battlefield, fighting terrorism, our AI product. And we go across the country and we say, you've installed a lot of things. You obviously see the power of AI. There's a question of what AI is. For some people, it's machine learning. For some people, it's algorithms. To some people, it's how do you actually extract value out of large language models. We will show you our product working in hours, and then you can actually compare it to what you would like to do. And in every other culture in the world, they're still very much driven by ideology of what should work. We have deep experience managing algorithms and now, by extension, large language models because of the work that our product's been used to power in the classified space.
Companies are eating it up.
And companies like it. They like the approach. I think, so one of the most important things that happened in software was large language models convinced people that you could get value out of AI. That's obvious. But they also somehow convinced people software is not a luxury product. It has to work. It's got to move from something that you just paid for to something that improves your margins, improves your ability to organize your business, makes your business more robust. Also, last not least, one of the great dangers of this kind of the world is safe, everything's going to work out, we're all going to get richer and happier and like each other more farce was that the assumptions that your products could be not robust, barely work, thin, add no value, that was a playbook from Silicon Valley onto the commercial space. That playbook has just completely failed. And our view of how you build this is you build something that is more valuable for the partner, whether it's a classified space or a company employing hundreds of thousands of people that will help them.
So, but companies have a lot of choices now, and increasingly more choices. There's the Googles and the Microsofts. And what is it that you are providing that is different? And who do you compete with?
Well, I mean, you should ask the clients who are buying it what we're providing. But like what we're really doing is saying, okay, everyone's making the same claim. The claim is you can get a large language model to increase your output at a lower cost. So you get more sales, more revenue, higher margins.
Yeah.
Okay, but we're making the same claim. The only thing is we're not making a claim. We're saying we will show you while they tell you. And those, like all these people making all these claims are the only marketing we really have. because the most important thing is now we've set a standard. The standard is we are going to make the enterprise more efficient. We're going to make the enterprise stronger. We're going to have innovation work in a way that it's differential, meaning innovation means nothing if 5 companies have the same exact margins, have the same exact ability to transform, are equally robust. We're saying pick a part of your business. For some people, by the way, it's not margins. It's not even, it's like...
Okay, before he goes further here, that was big. Basically, Karp saying, everybody else is talking about what they can potentially do for you. We can show you. We can show you in a matter of a few hours exactly what we can do for you, right? Rather than, the hype and the talk. We can show you. Give us a few hours with us and we're going to show you. So I think that matters.
They're worried that their supply chain may break tomorrow because they're dependent on a part that comes from a country that's about to be disrupted. They're worried that they have to figure out what's likely to break in their product. They don't have enough engineers. People have very disparate use cases, but the basic use case is my business has to be healthier, stronger than it is now, and healthy and stronger than the people I compete against.
Yeah, so very well said by Karp. And, I think that it was probably 2 quarters ago or 3 quarters ago when they divulged the information that AIP, could show a customer exactly what they could do in a matter of a day or less than a day, right? 4 to 6 hours, I believe, was a commentary. I mean, when I heard that, I'm like, oh my gosh, this has changed everything. This has changed everything for Palantir moving forward at this point in time. Because it used to be Palantir's sales cycle would be ridiculously long to really show a customer, what they could really do. And now the fact that it's that fast, that's a game changer. Next one up here, there's a chance that the Fed won't cut rates at all this year. This should be interesting.
On that bullish momentum for the rest of the year, joining us now to discuss is Sri Kumar, president at Sri Kumar Global Strategies, and Margie Patel, senior portfolio manager of multi-asset solutions at Allspring Global Investments. I can't think of 2 better people to have on. It's good to see you both in the daylight hours. Sri, I'm going to start with you because I think as much as anybody out there, you have been correct in anticipating where yields are going to go, what the Fed is going to do. And let me ask you this. Is there a chance that we will see exactly 0 rate cuts this year?
First of all, good to be with you again, Brian. Always a pleasure to be with you. And I think there is a chance we may not have a rate cut, not even in June, but the rest of the year, unless something else happens. It is not because of inflation coming down, but with interest rates having stayed so high for so long, something breaks in the system. You have another major banking crisis. The commercial real estate issues just break out. As we all know, when that happens, the Federal Reserve gives up on its inflation mandate, it gives up on employment mandate, and it becomes a cheerleader for the stock market. That requires it to ease, then it will ease. And that's the only reason I see easing taking place, Brian.
Margie, would you agree? Listen, there's always a chance at everything, but is there a 1% chance that we will get maybe 1 or even 0 rate cuts?
Whoa. Hold your horses. I think they're way too low, 1% chance in these sorts of things. Listen, I think there's about a 40% chance the Fed doesn't cut at all this year. I think there's a higher probability they do start cutting this year than they don't, but I think it's a pretty decent probability. How do you get there? I'll show you exactly how you get there. Have CPI keep coming in the 3s. And, maybe even we go up higher. Let's say oil price goes, pretty high this summer for whatever reason. Geopolitical conflicts or whatever they blame it on. So let's say all of a sudden oil price goes higher this summer. Next thing you know, oil's $90, $100 a barrel. All of a sudden, you're going to be looking at CPI 3.4, 3.5, 3.6. Fed's not going to be able to cut. Fed wants to see a 2. Wants to see a 2, if not 2 2s, before they can start cutting. And so that's how you get there. That's how in my mind, you get to that 40% probability, is if there's a scenario where CPI stays in the 3s and maybe even goes a little bit higher than where we're at right now. And the Fed's like, we can't really cut. We're at 3.5 on CPI. We want to be at 2. And if unemployment's fine at that moment, still 4% or under, then the Fed's going to look out there and say, well, there's really no reason to cut. We got CPI too high. The employment market still looks good. The stock market looks good. Like we can't cut. And so that's how you get to that place where all of a sudden, next thing you know, we go through this entire year without a cut. And by the way, like I always tell you guys, I don't think it's the worst thing. if you ask me, would I rather the Fed cut this year or not cut? I would rather than not cut this year, because that means the employment market stayed great, the stock market stayed great. That means everything was really good. Usually the Fed's going to cut when things start to get ugly.
How do you see it?
I think it's possible. The feeling has gone from 3 cuts to 2 cuts to now this whole uncertainty that maybe, in fact, we might not have any. I think the Fed's kind of in a box because the inflation rate has not come down according to their playbook, and they're a little flummoxed. I think they want to be careful by keeping rates too high and hurting the economy. We've had unemployment tick up a little bit. But on the other hand, with inflation not doing what they thought it should do, I think they're probably reluctant to cut. And maybe they'd like to keep rates here so that if there's a disaster, as she's referring to, they can come to the rescue and cut rates and save us.
Yeah, and Sri, we got the CPI, and there's a lot of dithering about inflation. How much is actually just housing and nothing else? I get that. What are you looking at? CPI is a big deal. PPI is a big deal. Things like the PCE and all these wonky things. What are the 1 or 2 most important things to Sri?
There's a couple of important things. Number one, Brian, we have had a massive expansion in the Fed's balance sheet, keeping zero interest rates for a lot longer than necessary. So when you do that, inflation is going to break out. What is different may be whether it breaks out in goods or services. That's what we have been the case. It is more likely that will happen, that the inflation will go away.
Okay, I'm assuming he was talking about goods versus services and where you would see inflation there. But if we had goods inflation come back, that would definitely be worrisome because that's the one part that we haven't really had. We've been dealing with services inflation recently, but if all of a sudden you have goods inflation come on top of that, that would be not the best. Let's just call it that. So overall, I will say the Fed's likely still got to cut at some point back half of the year, probably July is my opinion. But there's a pretty decent probability they don't cut at all, and I think everybody should actually kind of root for that. Is AI hype overblown?
Wondering whether if there is a breakdown in quality or momentum, both, the chips could be the most vulnerable. And maybe you're seeing some signs of that this week. Week-to-date losses in the semis. Marvell's down 9%, AMD's down 5.5%, and this is outside NVIDIA, obviously. Micron's down 4%, Broadcom's down 3.5%. Broadcom, quality momentum, that's been on the list. Christina Partsenevelos is here at Post 9 to help us look at this. Is that how you're thinking about this? Like, if you do have a bigger breakdown, your beat, your space is going to be the place to look, perhaps.
Oh, 100%. And I have so many comments to what you guys have said. But let's start with Broadcom and Marvell. Their earnings were last week. Why we're seeing this, weakness compared to other chip names is because, yes, they have AI momentum with their custom chips, but they're still exposed to the rest of the cyclical chip market. And specifically with Marvell, they guided weaker for this April quarter. So that, dragged on the stock. For Broadcom, they reinstated their full year target. Many were expecting that to go higher. They didn't. Yeah, there was some hype about the custom chips, but that you still need to keep that in mind when you talk about the momentum argument, when many of these chip companies, AMD, for example, are exposed to other facets of the market. And I question the timeline, which was what you both brought up. With NVIDIA, yes, they're launching their H200, their new B100, which is a completely new architecture for the GPU. They're talking about inferencing, which is 40% of their data center revenue, so that's going to help drive growth. But then you see a report from The Information just yesterday talking about Google, Microsoft, and Amazon warning that customers are cautious on their AI spending because they need to see that return. So I wonder in 6 months from now, if that return is not there, then those CapEx budgets get cut. And then that creates a different kind of momentum trade, or maybe less of a momentum.
Well, I think it creates at that point a reversal of the momentum for sure. And you're underscoring the element of why you've had this positive catalyst for all these semiconductors, because Microsoft, Alphabet, Amazon, they're sitting there, they're spending billions of dollars to build out the infrastructure, and they need these semiconductors to do it. And I'll go a little bit further. They need companies like Cadence and Synopsys as well.
Do they need that 2 years, 3 years from now? Constantly spending that amount?
That's a great question. And candidly,
so let me call a little baloney here, okay? So here's the deal. These big tech companies are spending all this money not for the next 6 months in what customers are going to do the next 6 months. They're spending this money for the next 16 years, okay? So these big tech companies, even if demand's not there in the short term, let's call it the next 6 to 12 months, it doesn't matter. They still got to spend a fortune because it is too big of a risk to them that if they don't, their competitors come and eat their lunch. And these guys see every single one of these big waves. You've got to spend up front. Cloud's a perfect example, right? Amazon was willing to get out there in front of everybody and look it. They won the cloud market, right? They were willing to spend a ton of money before the cloud was the big thing and it was pouring in the big numbers, and they won the biggest market share, right? Look at Uber. Uber was willing to lose a fortune of money before everybody else is willing to lose a fortune of money, and they ended up with the biggest market share by far, right? And you can go industry by industry. You've got to spend the big money up front. You're gonna lose a lot of money on this particular segment, but the hope is you build a good enough product that you win long term, right? You look at what Meta's doing with Llama. They're going to continue to spend a fortune, even though in the short term, it's not going to bring them in money. This is Meta's playbook. They did that with Facebook. They did that with Instagram. They've done that with WhatsApp. WhatsApp, they're just finally getting around to monetization of WhatsApp now at this point in time. They do that with every business segment. They're going to do that. They're doing that, obviously, with the metaverse, which long term will probably pull them in a lot of money, but right now it's lost them a lot. And they're doing that with Llama model, which is attracting a ridiculous amount of developers. And so, that's an important thing to understand about this. They spend a fortune up front planning to lose money for years, not for months, not for quarters, for years. And then once you've built a big enough market share, 7 years, 10 years down the road, then the cash flow starts pouring in. And all of a sudden, it's a game changer for your business forever. So, if any of them try to let their foot off the gas, they're going to get passed by their competitors, and then they're going to be screwed.
Yeah. I don't know that anyone really knows the answer to that. What's the length of this cycle? I think is the big question right now. And I think for people to come on the network and say, oh, I think it's going to be 6 months. I think it's going to be 3 years. I think they're just guessing.
But it's
I don't
a
think we know.
risk.
The stocks are not trading like,
No, you're right.
We've given the benefit of the doubt, so to speak, to almost everything.
These big chip cycles usually last 2 to 4 years. So, we're in year 2 now at this point in time. So the probability is it still lasts probably another year or two in terms of the big chip cycle, and then you start to see a slowdown, maybe toward the back half of 25, maybe toward the first half of 26. That sounds probable.
So the stocks are trading as if demand is sustainable forever. And if you just look at the charts, even from price to sales, bless you, for NVIDIA, you really see this just uptick. And so you question, there's comparisons with Cisco back in the 90s. Can it keep up this trend? Well, if those big guys don't come through, yes, NVIDIA will say, well, every other facet of the market, healthcare, auto, finance, they're all buying. But they're smaller players. They're not going to be spending, buying 200,000 GPUs like, let's say.
Look at NX. Isn't NXP's on the list?
NXPR is one of our holdings as well.
That's been one of those stocks that's been trading near a high. Jim Lebenthal just taking a little bit off the table the other day because my chip exposure has gotten too big. It's making me a little nervous because the space has gone crazy.
Absolutely. And, I look at the performance of the semiconductors. We have 11% exposure, and I question, again, how long can this continue? My personal perspective is there's actually election risk surrounding the semiconductors. And I think there's big election risks surrounding the semiconductors. So that's probably one of my primary concerns from a fundamental aspect.
Well, there's not much concern on Wall Street because Broadcom reiterated a buy. Its price target, $1,560, $1,560 for Broadcom. So, there continues to be all this bullish sentiment around these names. No one is, really willing to give up the ship on these yet.
No, and I think the challenge is that this is the first wave of AI, and people understand that if we go back to the .com bubble, the impact, the longer term impact that we're still seeing through cloud optimization, for instance, of the internet itself, that is the likelihood that this trend could persist decades from now in terms of what it can do for the larger economy. The easiest way, the easy button for AI right now, is chips. And so I think now you really have to take a step back and say, from a fundamental perspective, what, to Christina's point, what companies are spending on AI that are actually going to be able to monetize that AI. You're going to have to show results a lot sooner than 2025. This is going to be a 2024 story for some of these companies, and I think that's where you could see money come off the table, not necessarily because the AI trend is not sustainable or defensible, but because there's better ways to catch this second wave.
NVIDIA is going to remind us early next week exactly what their dominant role is, correct?
Yeah, I'm going to be there. So it's in San Jose, and it's their big AI event, GTC.
Monday,
and
Tuesday.
This is the first live event in 5 years, and there's so much hype around it that they had to rent out the SAP's stadium. So there's way more people expected. Every hotel is booked. We're expecting comments on, of course, their new chips this year, collaborations with partnerships, how they're going to monetize software. That's a big one for them, right? Because it's the whole ecosystem, and that's going to be the reoccurring revenue. And then inferencing, which was a little bit of a surprise. The second stage of a large language model, that is driving 40% of their data center revenue. But inferencing is at a lower price point, and then you think of their new AI chips, the B100, that's expected to be 30% higher than their H100. So, margins may be improved, but demand may drop. There may be demand shifting towards the custom chips from Amazon, Microsoft, et cetera. So there's a lot of factors at play. Value. But normally, according to UBS, the stock tends to go anywhere between 5 to 6% higher post these events on Monday. This is on a 6-year average.
Yes.
So there's alternatives.
So quite simply, in regards to NVIDIA, here's what's going to happen with this stock price, okay? Every single dip is going to be bought in NVIDIA, and it's going to continue to be bought in NVIDIA until there's a break in that business model and there's some sort of massive change in terms of numbers to the negative, and that might not happen this year. So for probably the remainder of this year, or at least most of this year, every single dip you get in that stock will end up being bought right up, and next thing you know, a week or two later, it's going to be at a new high, and then a new high, and then it'll keep going new high, then it will have some sort of dip. That dip will get bought up real quick, new high again. And so I think that's what's going to continue to play out with NVIDIA in the short term. And when I say the short term, I'm talking over this next 6 to 9 months. Where NVIDIA is 2 years from now, I think that's everybody's best guess. But in terms of next 6 to 9 months, every dip's going to continue to get bought because they're going to have a lot of new chips coming. H200 in the back half of this year. They're going to have that at a higher price point. Demand's still crazy for them and not slowing down. And then on top of that, software, right? And monetization of software side, I mean, gosh. Plus, new potential chips are going to show off. I mean, my goodness.
NVIDIA as an investment manager, but is there true competition when you think about it? It's NVIDIA and then everyone else.
100%.
Right. In the training process, no. I would say at the moment, no. But then in the inferencing stage, I do believe that there could be a lot more. And this is where maybe the technical side is not, the nerds in the chip world will say otherwise. But you have such specific tasks, and you can save a lot of money when you don't go for that giant expensive chip. So maybe I think that's where they'll lose a lot of the market share going forward. Right, but for now, first mover advantage. Right?
We'll look forward to seeing you out there Monday, Tuesday. Christina Partsinevelos, thanks for being here.
Alrighty, next one up here. This TikTok situation. The House passes TikTok bill?
The analyst joins us this morning, has a new note looking at the impact of a TikTok ban, something we've been trying to work our way through as we kept our eyes on the Hill. Dan, well, I want to ask you to give the calculus on passage in the Senate, but let's pretend this goes through. What happens?
Look, it's a game of high-stakes poker because, first of all, there's a retaliatory in terms of China. What do they do with Apple, Tesla in terms of that? Is this eventually acquired by big tech? What could the valuation be? Call it $100 billion plus. But then we believe 25% chance that this ultimately passes, just given the regulatory spider web that we see, clearly Meta benefits and others. But look, we believe this is a slippery slope. It's a watershed moment. You are playing a little with fire going down this route. And we think this is, within the Beltway, you can't put the genie back in the bottle. And I think now we need to see how this all plays out over the coming weeks in this sort of 202 drama.
So would you be re-rating Meta, Snap higher or lower?
So we still believe here, based on all of our work in the Beltway and our advisors, 25% chance this ultimately passes. But with that said, it's incrementally positive for Meta, for Snap, for others. But I think we need to see how this all plays out over the coming weeks. But no doubt, if I go back
There's been a massive slowdown in TikTok in terms of downloads and things like that over the past few months. I'll see if I can airdrop this. Actually, let me go ahead and pull this up for you guys. I think it's important. I shared this in the meta chat inside the my private group here. So TikTok's growth has collapsed in Q4 2023. 20-year-old Facebook grew faster than TikTok. Many young users have signed on to the short-form video app since the launch in 2016. Those core users are entering their 20s now, getting busier with other obligations, right? And so, here you can clearly see, geez, X had a tough run there, but you can see TikTok's in red. Yeah, it's literally below Facebook, which is crazy, and obviously getting way outpaced by YouTube, Instagram, and surprisingly Snapchat. So anyways, I think that is something that matters, right? So, at the end of the day, as a Meta shareholder, it really depends. If TikTok's not doing anything bad, and I don't know all the back end of their systems and whatnot, if TikTok's not doing anything bad, I'd rather have them not get banned. I know a lot of businesses, personally, small businesses that really rely on TikTok heavily for their marketing machine. So
the fact that we're actually here in the House.
And Meta's fine regardless if TikTok's around or not around. Meta's just fine. They don't need TikTok to be eliminated. I can tell you that much. Clearly, look at the numbers. They just don't, right? They're doing just fine with TikTok in the universe.
Given the pressure that we've seen, it's a surprise. And I think it's a surprise in Beijing. Look, I just got back from China. And in terms of overall Asia, and you see a lot of tensions that's rising. This is not what we want to see in Beijing.
So, what does this mean for the potential retaliatory measures that China could place here? If it's at least a near-term positive for a Meta or a Snap, but then China retaliates against U.S. tech, then what could that look like?
Well, and for Cook, for Musk, that's the issue here. Right. And as we've talked about a lot, right now it's not roses and rainbows for Apple and for Tesla in China. The retaliatory is what you worry about here. Not for Meta and others, but specifically for Apple and for Tesla. And that's why we say you're playing with fire. In other words, this game of high-stakes poker, it's great for grandstanding here, but not just from a First Amendment perspective, it could have massive implications from a retaliatory in what's already in terms of that U.S.-China Cold Tech war.
Yeah, I brought this up yesterday. True. How would we react if China decided, Tesla, you've got to divest your operations in China to BYD? We would not react well to that. That said, it's very much unclear, Dan, I should just point out from my own reporting, that there's any chance the Chinese would allow ByteDance to sell TikTok to another company, including the source code and the algorithm. That's not going to happen. And so it's very hard to figure out what will happen here. Before we let you go, though, I wanted to actually come back to Tesla and just have you respond to this Wells Fargo note today, questioning, obviously, significant discounts, profit per car coming way down, and their price target at Wells now, I think, $125.
Yeah, we strongly disagree with him. Obviously, we respect the analysts and the call, but I think right now overly negatively discounted in terms of the Tesla story. Look, near term, clearly units are going to be soft for 1Q. Just getting back from the region, I believe price cuts are now starting to subside in China. That's important. I think when you look through the next 6-9 months, we're going to look at this as more of a golden buying opportunity for Tesla over the next 2-3 years, especially with AI, rather than time to throw in the white towel. But for now, we all know, the New York City cab driver is bearish on Tesla here.
What does that mean? Sorry.
Everyone's bearish. The piling on's there. The bears are coming out of hibernation mode. I get it.
See what you mean, yeah.
But we believe now is not time throwing the towel on Tesla and Apple. I think we see here 6-9 months now, stock's much higher.
And like I said, in regards to Tesla, I think what's going to happen here is you're going to see margins trough either in this current quarter we're in or next quarter. And from there, the back half of the year, you're actually going to see margins start to tick up, which I think is going to be huge. And I mean, absolutely huge for Tesla stock when those margins, you finally start seeing them come starting to go up. Just in that direction is going to be very, very positive. But, in this quarter that's reported, in the next quarter, I think those will be very tough margin quarters. But back half of the year, I think we're looking pretty dang good. Okay. Appreciate y'all joining me as always. Thanks so much for being here. If you're looking to apply to join my private group, check out the pinned comment down there. Much love and have a great day.